So when you have buyers looking to move away from Russia, specifically those in Europe, can you quantify for us just how tight this market is?
I mean, the market is extremely tight. It's been tight for a long time, and it was tight even before we had this situation in Ukraine. Just 2 years ago, the price of European gas dropped below $1 per million BTU. It's been up above $100 per million BTU. Even in 21st November last year, before this Ukraine situation happened, we saw record high gas prices in Europe, counting into equivalent in terms of oil price of around $400 per barrel. So the kind of the energy crisis, there was an energy crisis before this Russian, because European inventories were very tight before the winter.
Yeah, sometimes I have a hard time in my brain working out what megawatts per hour means. So it's really interesting to hear those prices in terms of barrels of oil. Of course, the other complicating factor here is you have Russia, which is demanding for gas payment in rubles. German finance minister earlier in the week, speaking to Bloomberg, said this is blackmail. What sort of position does this put corporates in?
I think for the shipping company, of course, we are paid in dollars. Everything in shipping is paid in dollars. LNG is paid in dollars. Of course, pipeline gas is a bit different. So if the Russians are demanding to be paid in rubles, it's more a political situation than a corporate situation, I would say.
Right, but of course it's something that corporates are perhaps caught in the middle of. Now, are you seeing at this point, because prices have moved so high, what does flow look like? Have you gotten to the point, for example, where you're starting to see demand destruction really take a bite out of the supplies you're shipping, or is just the demand and the difficulty rerouting from Russia means that it's a pretty steady flow?
Yeah, of course we are seeing demand destruction. So we have seen a totally different picture in the flows happening the last 6 months or so. Back last summer, 1/6 of every US LNG cargo went to Europe. Today, 3 out of 4 US LNG cargoes goes to Europe. So the trade has flipped from being centered on Asia to going now to Europe. So we basically created a floating Atlantic pipeline of an armada of LNG carriers, just shipping all the LNG they can to Europe to alleviate the energy crisis.
Well, of course, and part of the reason is there's a financial incentive there, right? You have this premium in Europe over Asia. Do you see that lasting, and how much longer will that likely last?
Yeah, we have an energy crisis in Europe, but you also have an energy crisis in other more developing countries like Pakistan. So this is a global energy crisis. The LNG prices are high, not only in Europe, but also they are on par with European prices in Asia. In terms of the flows, we do see this agreement with the 15 BCM from US agreed with Biden and the European Union. It's not Biden who's going to solve this. It's Mr. Market rather than Mr. Biden. It's the pricing that's going to push the cargoes into Europe, not politicians in the short term. Longer term, the story is a bit different.
Yeah, I found this agreement between the U.S. and the EU really interesting, this supply deal to cut dependence on Russia, because it is, as you say, really left up to the corporate world, to the private sector to figure this out. I mean, is this something that can be done? I mean, you mentioned the number of cargo already going to Europe. It's already quite elevated compared to history. Can any more be done at this point without investing a lot of time and money?
Of course, it takes time to build LNG export plants. So Calcasieu Pass now, I saw they were up running from they pushed the button to they started to export 29 months. So the time of constructing a LNG export plant has fallen quite a lot as they have become more standardized, and generally it's easier to build them in America than most other places. So it's, it takes generally 3 years at least to get these volumes. What we can do in the short term is to squeeze out as much volume out of the existing capacity as possible. And with this kind of crisis, of course, everybody will have an incentives to maximize production and exports.
Well, let's get into that a bit. Beyond relying on the U.S. and beyond some of these short-term measures, what does Europe need to do to achieve energy independence from Russia?
Several things. Of course, the biggest gas consumer in Europe is Germany, and they don't have a single LNG import terminal, so they are fast-tracking approval now for 2, possibly 3 FSRU or import terminals. So the FSRU market's been red hot the last couple of 3 years, in contrast to the last 5 years when that market has been literally dead. So we're seeing that other countries in Europe are doing the same. Italy, France are also signaling that they need to have more LNG import terminals. But what is happening is that Europe is gobbling up all this LNG, and countries in Asia, poorer countries like India and Pakistan, they are not getting access to that LNG, and they are consuming more coal because that's the alternative feedstock in the short run, at least for them.
Oystein, you know, it's been a remarkably volatile environment for LNG, but as we've been talking about, prices have also been very elevated. There's a lot of demand. What has this environment meant for Flex LNG specifically in profitability?
Yeah, actually, in the short term, it's been not positive because we came from the strongest spot market ever in Q4. In Q4, the flow was still mostly towards Asia, and that means long sailing distances. The US volumes are the most flexible in the world. There's no destination clauses, so that volume can go wherever it wants. So prior to the energy crisis spiraling in November, most cargoes went to Asia, and that means long sailing distances. When Europe's energy crisis have become so severe that they are pricing out the Asian demand, sailing distances are shorter. So going from US to Europe is 5,000 nautical miles. If you go to Asia, it's generally 10,000 nautical miles. And when the Panama Canal is clogging up, which it did last winter, you have 15,000 nautical miles. So in the short term, actually, the spot market has become much weaker. On the other side, the term market has become stronger, and as a bit of a, you know, you're living in separate lives, but because with this kind of cargo prices, people have become very concerned about having access to tonnage. So people or the charters are willing to pay up to secure ships for longer durations, while the spot market has been a bit soft in the beginning of the year. I would say the spot market shifted and turned around about a month ago, so it's gradually becoming better.